In this month's Economic Update, Kaplan Professional Education's Trevor Trahan speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Trevor Trahan, and this month we're speaking with AMP's chief economist, Shane Oliver. Thanks for joining us today, Shane.
Pleasure.
After the cash rate cut in February and the hold in March, what do you expect the RBA to do with interest rates for the rest of the year?
I think the Reserve Bank will cut interest rates further, and the debate is by how much. The Reserve Bank often seeks to confuse everybody, I think. It's just to annoy us, but sometimes they've eased 1 month after another, done two together, and sometimes they've waited a couple of months. So it could well be they wait out to May, for example, to cut. But I think the reality is that the Australian economy is growing at a subpar pace. Confidence is low. The Australian dollar has come down, but it's still too high. Wages growth is benign, inflation's benign, so all of those things point in the direction of further interest rate cuts, at least one more, probably in, I think by May, might have occurred before then, but at least by May, and then maybe one or two more after that. So I think that the skew is all on the downside for interest rates here. And the basic problem in Australia is that as we're coming from a mining investment, mining boom-driven economy, it needs to rebalance. That rebalancing is occurring. It's just not occurring quickly enough.
What was the motivation behind China's central bank cutting the benchmark deposit and loan interest rates by 25 basis points at the start of March?
I think what we're seeing in China is a realisation by the Chinese authorities, both the government and the People's Bank of China, that growth is subpar, that's causing a fall in inflation, and that the risks to growth were on the downside. And against that backdrop, they could afford, like most other central banks around the world, to ease up on the policy brake. So we saw a first interest rate cut in November last year, and then in January or thereabouts, a few months ago now, we saw a reduction in the reserves that banks have to put aside, so that frees up some money to lend, and now we're seeing another interest rate cut. My feeling is there's probably more to go from the central bank in China, that that they're targeting 7% growth this year. To achieve that, they'll probably have to cut interest rates lower.
According to government data, the US added 295,000 jobs in February. What will this mean for the overall economic health of the US?
Well, I think the bottom line is that the US economy is now onto a solid footing. Just worth pointing out at the start, the US is not booming. This is not like the recovery from the early 80s recession, let alone that from the early 90s recession. It's a slower, grinding recovery, but nevertheless it is occurring. And the fact that we've got another month of good jobs growth, we've been sort of pushing up towards that 300,000 on average a month over the last year. Unemployment's fallen to 5.5%. That all attest to the US economy on the mend again, and it basically is appointed to the Fed eventually starting to raise interest rates, either in June or September this year. So pretty good news coming out of the US. And it's worth putting that in context. When the Fed talks about raising rates, a lot of investors get scared, can cause volatility, all that sort of stuff. It's only occurring because the Fed was successful. And just bear in mind, when they started cutting interest rates back in 2008, didn't exactly help the share market. Shares kept falling well through that period despite the Fed rate cuts. Now they're raising rates. It's only a sign of stronger growth in the US, which by and large is a good thing.
What is the wider financial impact on the EU of Greece's economic crisis?
Well, the Greece story has now been with us since November 2009. If you go back to when it first hit the headlines, started to cause concern, then it really hit the proverbial hit the fan in 2010, particularly in 2011, and then again in 2012, and then it's been a bit quiet over the last few years. It's come back again because of basically a change of government. The Greeks decided they'd had enough of austerity and they voted for Syriza, led by a guy called Tsipras. Hopefully I pronounced his name right there, but that mandate they had was one of winding back the austerity, and there's been a lot of debate as to precisely how they do that. The trouble is that they're still dependent on funding from the rest of Europe, from the IMF and the ECB, and therefore they, if anything, they sort of think, well, we'll threaten to have a Grexit, we'll threaten to leave the euro, and that'll have the rest of Europe shaking in their boots, and of course the rest of Europe saying, well, we're a lot stronger now. Look at bond yields in Spain and Italy, they've collapsed. Those old worries about a Grexit causing a breakup of the euro more generally seem to have faded a little bit. But nevertheless, it's sort of happening on the sidelines, and that's causing bouts of uncertainty about how Europe will go. But I think it's just worth putting it in context. At the end of the day, 70% of Greeks want to stay in the euro. I think the Greek government will have to compromise, otherwise they'll get booted out themselves, because most Greeks, they want to stay in the euro. Secondly, the peripheral countries, the ones that used to be vulnerable in Europe, the Portugals, the Spains, the Irelands, they're a lot stronger than they were a few years ago, and I think they'll ride this out. And thirdly, it's just worth looking at Europe generally. It seems to be on the mend. Growth in Europe's gradually picking up. Recent indicators for bank lending have improved. The ECB has discovered quantitative easing. The euro has fallen, which will help European exporters. So a whole bunch of factors, I think, are actually more positive for Europe, and that's offsetting the negatives coming out of the Greek debate.
Thanks for your time today, Shane.
My pleasure, thank you.
And that brings us to the end of the April PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. See you again next time.